All right. Good evening to you all. We are still in April. Financial Literacy Month campaign is ongoing. And today we are having our Financial Literacy Month webinar series. Today we are talking about tax planning. And there are two things that are certain in life: debt and taxes. So you cannot avoid taxes as we plan our finances and as we do our various investments. We should also know that there are tax implications. So today we are going to look at how we can plan our taxes and also learn about the Ghana tax laws. We have two amazing speakers with us today to help us understand the tax laws in Ghana and how we can plan our taxes. My name is Peter Kwejo Asarinyako, and I will be your moderator for today. So this presentation is in the spirit of supporting the improving financial awareness and financial literacy movement in Ghana. This presentation is put together by the Improving Financial Awareness and Financial Literacy Movement in Ghana, Deloitte Ghana Center for Financial Literacy Education Africa, and the Financial Awareness Foundation. On the agenda, we are going to look at a serious issue that is happening around the world, the issue of financial illiteracy and how the movement seeks to solve this major challenge. Then we will zoom into our presentation for today. Then we will give a gift. So we have a gift for all our audience, those joining us live on Zoom, and those watching on our social media platforms. We have a gift for you today. So today's presenters, we have Mr. Gilbert Addo. He is a manager at Deloitte Ghana, a manager for tax and regulatory service at Deloitte Ghana. We have Madam Betty Otre, also a manager for tax and regulatory service at Deloitte Ghana. And myself. So zooming into our presentation, one question we always ask our audience is, are you managing your finances or your finances are managing you? This is something we need to ask ourselves every day of our life. We need to ask ourselves whether we are managing our personal finances or our personal finances managing us. And by the end of this presentation, I think we will get a skill set to manage our finances. There's a huge challenge that is happening around the globe. Even before COVID-19, it was a challenge, but after COVID, it has become worse. When you look at Ghana, we have a population of about 30 million Ghanaians. And according to the stats, employment rate is around 41%. Unemployment rate is near 4.6, leaving 13% of our population, over 4 million Ghanaians, so poor that they cannot afford 3 meals a day for themselves and their family. When you go to the rural communities, it is even higher. Many people are struggling to survive less than 5 cedis a day, and that is a huge challenge. This is as a result of financial illiteracy and lack of financial awareness. So we have created what we call the Improving Financial Awareness and Financial Literacy movement to help solve this challenge. So we believe COVID-19 has come upon us, and we cannot predict what will happen next. And so we need to better manage our personal finance. The only way out is to practice better personal financial management. And that is what the movement seeks to champion how people better practice sound financial decisions. So the movement is here to help solve this challenge. The movement is built around two campaign venues: April as Financial Literacy Month and October as Estate and Gift Planning Awareness Month. During these two campaign venues, we share educational and motivational content and also remind people to make informed lifelong financial decisions to get and keep their financial house in order. And it is built around what we call the GI effect. We believe we can touch the over 30 million Ghanaians by when we are able to touch the financial service and product providers. They will also touch their clients and their customers. When we touch employers, they will also touch their employees. When we touch the non-profit, religious organizations, social change organizations, they will also touch their beneficiaries. When we touch the educational institutions, the media, we believe we can touch the over 30 million Ghanaians that we have. So this is our strategy to educate every single Ghanaian twice in a year. So when you go on Google right now and you touch Financial Literacy Month Ghana, you will see a lot of organizations that are participating in Financial Literacy Month, sharing the essential principles to personal financial knowledge to help people better manage their personal finance. So we encourage everyone to get involved. Talk to someone about financial awareness and financial literacy. When you get the information that is going to be shared here, you also need to be an agent of change and share this information with your family and friends. There are a lot of links. Valentino will put these links in the chat box for you to access them and see what others are doing, what the movement is all about, and how you can also participate in the movement. Next slide. So you don't need special talent or skill set to manage your personal finance. All you need is the right information and being able to apply this information to your everyday life decisions. And that is what we are going to share with you today. Tax is an essential part of your financial planning. And let's make this disclaimer. This is not intended to serve as a specific tax, legal, or investment advice. This is an educational material. We are providing education to the people so that you can then take your own decisions. And there are always tax professionals that you can reach out to help you put your tax planning together. Deloitte is here. If you want to plan your taxes, Deloitte is there to help you plan your taxes. So which area of your personal finances frustrates you the most? Is it about paying bills? Is it about finding the right kind of work? Is it about gift planning, investments research, cash flow statements? Each of us have one area of our personal finances that frustrates us the most. Mine has to do with tax preparation. And that is why we have Deloitte here today to share with us what taxes is all about and how we can leverage this information to help us plan our taxes. We don't need to leave our future to chance. We don't need to gamble with our future. We need to be in charge of our financial life. So as part of what the movement seeks to do, the FA Association, the Financial Awareness Foundation, has come out with what we call the Foundation to Financial Awareness and Financial Literacy. And this is built around 7 elements. We believe if each individual is able to go through all this process, they will become financially literate. Talking about paperwork, talking about net worth, your cash flow, your employment benefits, your goals, your financial independence, major expenditures, investment, taxes, insurance and risk management, estate and gift planning. So these are the elements that comes together to make a person financially aware and financially literate. And today we are focusing on taxes. Last week we had a presentation on financial independence and retirement. Next week we have a presentation on insurance and risk management. And today we are talking about taxes. If you want to develop a comprehensive financial plan, there are 6 steps you need to follow. And at the end of this presentation, I will throw some more light on how best you can plan your finances, do your financial planning. And so at this moment, we will zoom into our presentation. And the first person to present is Mr. Gilbert Addo. Gilbert is a manager in Deloitte, West Africa Tax and Regulatory Practice. He has over 11 years of experience in tax compliance and advisory services, including tax due diligence, tax health reviews, various global mobility, that is services in various industry sectors such as shipping, airlines, financial institutions, that cut across the banking and non-banking sector, telecommunications, and manufacturing, among others. Gilbert is a member of Institute of Chartered Accountants Ghana and also a member of the Chartered Institute of Taxation Ghana. He holds a bachelor's degree in commerce from the University of Cape Coast. Without much ado, I will invite Mr. Gilbert to take us through our first presentation. You are welcome, Mr. Gilbert.
Thank you very much, Peter. And I would want to also thank the Financial Foundation and Awareness team for giving Deloitte the opportunity to come and share an insight on taxation. And in your submission, I picked one point that resonates with me very well. So if you don't need a special skill to manage your finances. You don't need, and indeed, you do not need a special skill. All you need is knowledge to be able to address some of these issues. And principally, taxation is very key. And how do you do tax planning? It's understanding the tax and how it operates. Hence, our presentation on the overview of taxation in Ghana and effective tax plan. I'm going to do this with my colleague, Betty. So Betty, let's roll. So today's overview, we are principally going to look at taxation in Ghana, because for you to understand tax planning, you need to then know what it encompasses. There is a famous quote by Albert Einstein. Since Peter started with a quote, I would also want to start with a quote. So I quote, the hardest thing in the world is to understand is the income tax. So the hardest thing in the world to understand is the income tax. Do you agree? And this is coming from the famous, knowledgeable Albert Einstein. So you could see that tax is very critical to what we do in terms of our financial planning. Okay, so what are we going to look at? We are going to look at the overview of taxation in Ghana. And for tax planning, you need to be aware of what the issues are before you can be able to plan. So once we take you through that, and then we'll also take you to some basic concepts in tax planning. We have limited time, but we'll try as much as possible to ensure that we touch on every issue meticulously. Okay. So Betty, you take over.
Okay, thank you, Gilbert. Yes, so as my colleague Gilbert has rightly said, we would be giving you an overview of taxes in Ghana. You can't plan for something you have no knowledge about. And so it's essential that you have a little bit of understanding of what the general tax laws in Ghana are so that you can plan your way effectively around it. So basically that is what we'll be going through today. So in every practice, there are some laws, regulations, or guidelines that bind the practice. And so these are basically the laws that details the tax practice. So these acts are guidelines, and so if you need further information on anything in relation to tax laws in Ghana, these are your go-to laws. You have the VAT Act, you have the Income Tax Act, you have the Labor Act, National Pensions Act, and all of those documents. All right. So now, what are the forms of taxes in Ghana? Okay. Basically, we have direct taxes and then indirect taxes. Now, direct taxes are levied on income or profits of the person or of an individual. And under this direct taxes, we have personal income taxes, withholding taxes, and then company or corporate income tax. On the other leg, we have indirect taxes, which are levied on goods and services rather than on individuals. And these are made up of VAT, value added tax, you have the excise duty, you have your communication service tax, amongst others. So these are the basic forms of taxes in Ghana, and we'll be going into details in the subsequent slides, all right, to know what makes up each of these forms of taxes. All right. So under direct tax, as we indicated, we have income tax. Now, what tax is payable by a person or who is deemed to be liable to tax in Ghana? So the tax law states that anyone who has a chargeable income for the year or receives a final withholding payment during the year is liable to tax in Ghana. Okay, so these are the basic conditions. You need to have a chargeable income or you need to have received a final withholding payment in order to be liable to pay tax. So how do you calculate the tax? Is by applying the relevant tax rate on the chargeable income and deducting any foreign credit that is allowable. All right, so this is how tax is calculated for each person that is liable to tax. Okay, now what is a chargeable income? Because in the previous slide, you said you apply the applicable rate on the chargeable income. What makes up your chargeable income? Your chargeable income is a person's assessable income for a year of assessment from employment, from business, or from investment, less any amount of deductions allowable. Okay, so these are the forms of income that are subject to tax or that makes up the assessable income of a person. Employment, business, or investment. This should always stick into your mind. The tax law also states that the chargeable income from each of these sources should be assessed separately. Okay. Now, assessable income. Okay. In order to get your chargeable income, you need to derive your assessable income. Now, assessable income is income from the income, business, employment, and then investment. Now, for resident persons, how are they taxed? And for non-resident persons, how are they also taxed? The tax law states that for a resident person, they are subject to tax on income from employment, business, or investment, whether or not the source has ceased. And the underlying factor for the Ghana taxes is this basic law, which is termed as the worldwide taxation. Okay, so this states that for resident persons, regardless of where the income is being paid, by virtue of you being a resident person in Ghana, this income is subject to tax in Ghana. You need to report this income in Ghana and then pay taxes thereon. That is deemed to be the worldwide taxing rule. And then for non-resident persons, they are subject to tax only on income sourced in Ghana. Okay, so this is basically the difference between how residents and non-residents are taxed in Ghana. And then for this income, the applicable tax rates are applied on it. So we'll look at the tax rates in more details in the subsequent slides. Okay. Right. So who is a resident person? This is also a very essential fact, because then what determines a resident person will then determine how you are subject to tax. Okay, so what qualifies an individual or a person to be a resident or a non-resident person? Okay, so for a Ghanaian citizen like yourself and I, by virtue of us being citizens of Ghana, we are basically resident persons, or we are deemed to be a resident person for tax purposes by de facto reason. Okay. However, for foreign nationals or for expatriates who come to Ghana, how do they qualify to be residents? They should have stayed in the country for 183 days in aggregate within any 12-month period. So the basic things to look out for is the 12-month period, which is not January to December, but 12-month period from when the foreign national or the expatriate steps foot in Ghana. So if an expatriate comes to Ghana in March, his 12-month period would be March to February of the following year. So let's say 2022, if you come to Ghana in March 2022, your 12-month period will be March 2022 to February 2023. That would be your 12-month period. And so within this 12-month period, we are to count the number of days spent in Ghana. And it shouldn't necessarily be continuous stay. You can be going back and forth to your home country or to other countries. However, within this 12-month period, if you clock more than 183 days, then it means you are deemed to be a resident for tax purposes in Ghana, right? And then also for employees or officials of government, if they are posted abroad, regardless of the number of days spent outside, they are still deemed to be residents of Ghana for tax purposes. And then for Ghanaian citizens as well who are temporarily absent from the country for a period not more than 365 continuous days, if that citizen has a permanent home in Ghana, then that individual will still be considered as a resident person for tax purposes. Right. So this is what qualifies each and every one of these groups to be deemed to be a resident person for tax purposes. Now, on the other leg, we also have the non-residents, and this is anybody who is not a Ghanaian citizen. Okay, and an expatriate who is unable to clock the 183 days within the 12-month period. So that is how you qualify to be a resident or a non-resident person. Okay. Now, for companies or institutions as well, what qualifies these entities to be resident entities? For companies, if you are incorporated under the Companies Act, then it qualifies you to be a resident company. And then if your management and control is exercised in Ghana at any point in time during the year, then that also qualifies that company to be a resident company. And for partnerships as well, if any of the partners resided in Ghana at any point in time during the year, then that partnership is deemed to be a resident partnership. And then for trust as well, if the trust is established in Ghana or any of the trustees are residents in Ghana at any time during the year, then that also qualifies that trust to be a resident trust for tax purposes. Okay. Now, moving on to classification of income and the allowable deductions, because this forms an essential part of how taxes are calculated. Okay. As we indicated, we have three main sources of income: income from employment, income from business, and income from investment, which we'll be delving into separately. So I'll be handling the income from employment, and then my colleague Gilbert will take over from the business and then the investment aspect. All right. So then looking at income from employment, what's any income or gain or profit that is received from an employment relationship is deemed to be a gain or a profit and is subject to tax in Ghana, unless expressly exempted by the law. So any payments that you receive from your employer or associate of the employer, or in respect of past, present, or prospective employments, these are all deemed to be gains or profits from employment and are subject to tax in Ghana. Okay, so these are the various types. You have your salaries, your allowances, all other benefits, cash benefits, non-cash benefits, overtime, bonus. All these payments are deemed to be gains or profits from employment and are subject to tax in Ghana. and they are deemed to be income from employment. And so without an employment relationship, you wouldn't receive these income streams. All right. So as I indicated, any income received is due or liable to tax, unless of course the tax law has especially stated it to be exempt. Now, the previous slide we looked at, this is not an exhaustive list of all the allowances or the gains or profits from employment, because of course the tax law will not be able to put out an exhaustive list. However, it provides a guideline on what is to be exempt. Okay, so that if you receive an income and you are indecisive about how to tax it or whether it is subject to tax, you need to assess it to determine if it is exempt or not. If it doesn't meet the criteria to be exempt, then it would be subject or liable to tax. Okay, so which types of income are exempt from tax? We have these types as expressly stated by the law. Okay, and this is the discharge or reimbursement of an expense. And then, sorry, please. Okay, incurred by an individual on behalf of his or her employer. And then we also have a reimbursement or discharge of an employee's medical, dental, or health insurance expense where benefits is available to all employees on an equal basis. Now, equal basis here doesn't mean all levels should be receiving the same amount of benefits or profits or anything, but then it just says that for each level, the benefits applicable to them should be the same. If all managers are receiving this particular benefits, then that is fine. If all associates are receiving this particular level of benefits, then that is fine. So that is where the equal basis comes in. It doesn't mean the amount should necessarily be the same. And then also, if there is a cost of passage for commencement or completion of employment for first-time employment in Ghana, then that amount is also exempt from tax. And then we also have a situation where the company provides accommodation to its employees in the mining, farming, business, timber, or these particular sectors, then these are exempt from tax. However, any sector outside of these are deemed to be taxable. They are deemed as benefit in kind if an accommodation is provided by any of these sectors outside of what has been provided here. And then also if there's a payment made to employees on a non-discriminatory basis, which by reason of the size, type, and frequency, it is unreasonable or administratively impracticable for the employer to account or to allocate to each of the employees, then that payment is deemed to be exempt. And then we also have redundancy pay, where if an employee receives payment as a result of termination of employment stemming from management's decision, then that income is not subject to tax in Ghana. Okay. However, if the employee resigns of his or her own volition, then any benefits paid out to this employee would be subject to tax in Ghana. And then we also have payments received from pension or compensation for death or injury. So these are the expressly exempt income as stated by the tax law. So if any of these incomes are received, then you know to exempt them from tax purposes. All right. Gilbert, you can please continue from there.
Thank you, Betty. So Betty did touch on some key points I would want to reiterate. She made mention of chargeable income, and chargeable income in our normal financial reporting could be your gross income. So we said chargeable income is your assessable income less allowable deduction. So if you take your normal financial reporting, you have your revenue, you take out your direct cost, you get your gross profit, you take out other costs, you get your net profit. Taxation has its own way of presentation. And that is why we are coming up with this term that stems out from the law. Tax is also jurisdictional in nature. So that's why we have non-resident and other things that has already been touched on. Now we have three classifications of income. My colleague Betty has already touched on income from employment. So I'm going to look at income from what? Investment. Now, if you look at the text of the law, it seeks to say that income from employment, income from business, or investment, meaning that I can invest with my employment income and I can also invest with my business income. So what then are income from business? You agree to the fact that some of us engage in the supply of goods, and then we also engage in the supply of services. Some of us also have businesses that have what? Capital assets, the assets that you use to do your operations. Now, all these can be sold, especially the asset, at any point in time to earn revenue. So income from business is basically looking at what the consideration you get as a result of what? Engaging in the supply of goods or the provision of what? Service. So the different types of income from business has been spelled out here. That's what I've touched on briefly. We have consideration from your trading stock if you sell your goods and services. You may also have capital assets, which you may also decide to sell at any point in time, and whatever you earn from there is taxable. So let's go to income from investment. When we say income from investment, what encompasses income from investment? Broadly, one would say that income from investment is what? Passive income. When we say passive income, in literal terms, we say the money is working for you. So you have you have money, you go and buy shares. You have some surpluses, you go and buy treasury bills, or you invest in bonds. You realize that these monies are working for you. And once they are working for you, earn certain returns as a result of engaging in that investment activity. Hence, financial planning is to guard against or protect your future, so you make certain investments. Now, the returns or the income you make, when I say returns, basically is the income that you earn from this investment is what we term as what? Income from what? Investment. But please, let's note that we may have businesses whose mode of operation is to do investments. So for such entities, the income that they earn will still be defined as what? Income from a business, because that is what they do. So for investment, we have what? Dividends, interest, you have rental income. All these encompasses what? Income from what? Investment. And gifts, which is a bit contentious, but I mean, in our jurisdiction, when we talk about gift, people think it's not that. It is taxable because you got that gift as a result of engaging in that activity. The ordinary person on the street will not have been given that gift. Okay, so basically, and that is what we term as what? Income from business, and then income from what? Investment. But we did indicate that. Please give me a second. We did indicate that when we define chargeable income, we said that accessible income less allowable deduction. So the law is cognizant of the fact that if you do not incur cost, you will not earn revenue. Therefore, I cannot just come and say, I am taking my pound of flesh from your total revenue or the gross revenue. I need to take into account the expenses that you have incurred in generating that revenue. But the expenses should be what? Allowed. It should be within the context of the law. And the context of the law seeks to posit that all expenses that you incur should be geared towards the business and not for personal reasons. So we have what we call the deduction rule. Then how do the deduction rule empowers us to be able to test all your expenditure lines to see whether it stands the test of time. Now, what are the key parameters? We call it what? The residual deduction. So for the residual deduction, all that it does is it says that, okay, you have incurred all these expenses. Let me subject it to this test. And the test is what we call the when rule. All that it seeks to say is that the expenditure you have incurred should be wholly necessarily and exclusively geared towards the generation of the income. So if you incur an expense of, let's say, 100, it should be something that is wholly geared towards what? Your business activity to generate income. It should be an expenditure the company cannot do without. Imagine we are having this presentation and everything goes haywire. I mean, it's so we need to buy data in order to do this. It's a necessary expenditure in order to ensure that this program, goes on successfully. So that is the parameters that has been set in the law to help in what? Assessing your expenditure. And having an ample understanding of it is in what? Adequate tax planning. Now, this rule is not applicable to capital expenditure, because if you understand financial reporting, a capital expenditure is not a revenue expenditure. So it will not form part of what? Your normal P&L activities. But the law also has specific rules for some line of what? Transactions. So we call that what? The specific deduction. For want of time, we are doing a high-level discussion. So some of these specific rules pertain to these streams of transactions. We have what we call repairs and improvement, research and development. You can't just get up and do any kind of research. The research should be something that should be geared towards product development. And this product is what you sell to generate income. We have what we call capital allowance. The law is cognizant of the fact that you have invested in getting what? Assets. Now, it is these assets that you turn around to generate income. So I have to give you some form of what? Allowance to reduce or ease your tax burden. And understanding of this is very critical and aids in what? Adequate what? Tax planning. So we have the added finance cost, loss from business or investment, and losses on realization of assets and what? Assets and liabilities. And it's very important that you understand some of these specific deduction rules. So we've touched briefly on direct taxes and what you must know. Now let's go to indirect tax. The focal point for indirect tax is what? VAT, value added tax. So basically when we say value added tax, what are we trying to look at? Value added tax is what? Consumption tax. If you do not consume, you do not pay the tax. That is why we say it's what? Indirect. If you take the word for itself, indirect tax. And the other tax type is what? Direct tax. So the direct tax, as my colleague Betty said, is borne by you personally, the earner of the income. The indirect tax is paid by someone who is to consume a service or buy goods. So that is what principally VAT is all about, value addition. So the tax is on what? Every value that you have added in converting the product into its final state. So for instance, you see that bottled water I am having. It started from a raw material stage. The bottle and the water went through a certain process. So for each process, each stage, there's some value addition and the tax is triggered. But because the manufacturer is not the final consumer, the final consumer, is the one who will pay the tax. Great. Now, you can't just get up and say that, okay, you are charging VAT. You need to be a taxable person who has engaged in what? A taxable activity. That is it. And then lastly, the calculation of the VAT is premised on some principle. Currently, to calculate your VAT, you have to add the levies. And when we say the levies, what are we talking about? We are talking about the COVID levy, the NHIL, and the Get Fund levy. So for instance, if your transaction value is 100 cedis, ordinarily, you would have charged the VAT on the 100 cedis. But now, based on the provisions of the law, you have to increase the transactional value by 6 and charge the VAT on 106 instead. So that is the position now. Great. So we say who. So who, when is a transaction within the scope of VAT? One will say, when? Because you are saying VAT, what then happens? Now, VAT is where there is supply of goods and services. Supply. So the goods is going to someone, and that supply is what we term as a taxable supply. Taxable supply. You are giving something out for consideration, but that supply should be made by what? A taxable person. And I like the law a lot. The law did not talk about it being made by ordinary persons in the street. He's saying that it should be made by a taxable person. So you ask yourself, who is a taxable person? Is it the ordinary person on the street or you and I? And that taxable person should engage in some form of what? Taxable activity. So three interesting terms here: taxable supply, taxable person, and taxable activity. And this may create some form of confusion in your mind. What is all this that they are talking about to help me in my financial planning? Okay, Betty, let's move on. So the key thing is, for one to be able to charge VAT, you need to register. You need to register. That is why it is not for anybody. It is for a taxable person. You need to register. So you register with the Revenue Authority, but the registration does not just come up. I'm there and I say, oh, fine, I think I have to register for VAT. No, there are revenue thresholds that when it's triggered, VAT must be, you must register and charge VAT. So what is the threshold? If you know that within any 12-month period or less, your revenue, and when we say your revenue, I'm not talking about revenue less expense. I'm talking about your revenue, your pure revenue. If your pure revenue exceeds 200,000 Ghana cedis for any 12-month period or less, the registration requirement is triggered automatically, and you have to go and register. And the reason why this is key is that you may be on this platform, you engage in a certain kind of activity. Financial planning, if you don't know this and you are caught by the law, you go and pay a huge penalty, and we'll look at that later. There are instances whereby if you expect that within any month, reasonably, per the activities that you engage in, you are going to earn a revenue that exceeds this threshold, quickly you go and do what? Register and charge the VAT. So it is automatically triggered and it is binding on all parties that are engaged in a taxable activity. And when we say taxable activity, principally is what? Sale and supply of what? Goods and what? Services. Okay. So in as much as you can be registered, the Commissioner General can also deregister you. You can't be deregistered. So under what circumstances can you be deregistered? If you do not meet the registration requirement, you will be deregistered. If you do not have sound accounting books of account, you will be deregistered. And you will not just be deregistered. They will do the necessary tax audit and everything, and then you would be deregistered. You can also voluntarily deregister. You say that, fine, my activities are not going as expected. Hence, you write to the Revenue Authority, and it's part of the financial planning. You inform the Revenue Authority that I was expecting this, it's not forthcoming over the years, so I want to deregister, and then you have your peace of mind. Let's proceed. So we move on to some key VAT principles. Some key VAT principles. So we asked, and I earlier on posed that question. I said that you saw taxable supply, you saw taxable person, you saw taxable activity. We have structured this slides in order not to bore you with law. So when we say taxable supply, like I said, it's what? The supply of goods and services. Not for consideration. That is why you are in business, for consideration. And the VAT is triggered, but there are supplies that are generally exempted. We call them exempt supply. We'll look at that later. And then a taxable person, as I've already indicated, is one who is registered to charge VAT. And The taxable activity is an activity which is carried on in the country or partly in the country. One thing we should all know, the beauty of taxation is that it is jurisdictional. So UK cannot bring its tax law here. Dubai cannot bring its tax law here. Neither can we also take our tax law there. So everything is premised on activities that happens within the country. We call it nexus, the connection of the activity that generated the income. So that is what we term as what taxable what activity. Okay. That, Betty, have you moved to the next slide?
Yes, Gilbert.
Great. So on the next slide, we look at what types of what taxable supplies. You recall I said taxable supply. But what are the types of taxable supply? We have what we call the standard rated supply, and then the exempt supply and the relief supply. Now, when we say exempt supply, the law has stated that for these transactions, do not charge VAT on them. For these transactions, charge VAT on them. So for the transaction that you can charge VAT on, that is what we classify as what the standard rated supply. The ones that you are not to charge VAT on is what we call the exempt supply. And there are some supplies that are relieved, especially those who are in the mining sector. They have special concessions. We call it stability agreement. So the government is saying that, okay, because of the investment that you are doing, you are relieved from VAT on certain activities. So you, the person who engaged or who supplied those mining entities with some goods or services, you will charge the VAT. But when you charge, they will give you a document that relieves them of the charge or the VAT you have imposed on them. So what are some of these exempt supplies? Financial services. Gradually it is crippling in. We now have e-levy and the other things that are crippling in. But then generally, activities on financial services are exempted from VAT. Pharmaceutical products and all other activities that has been spelled out here are deemed as what exempt supply. Therefore, when I supply it, I'm not supposed to charge VAT. That is what it means. Then we have what we call what the zero rated supply. You see, when we say zero rated supply, it doesn't mean the VAT is not charged. The VAT is charged, but the rate so imposed is zero. And principally is for what? Exports of what? Goods and services. And this hinges on what? It hinges on what? Consumption. The over-anchoring principle of VAT is consumption. So if you are not consuming the goods or service within Ghana, then that means you are not supposed to suffer VAT on them. So for some of you who have been traveling, we have not had the privilege to be traveling a lot, but for some of you who have been traveling, if you go to the airport, especially places like South Africa, and you buy certain items that you do not consume, and those items are not food. You buy, let's say, shirts, other things that you do not wear or consume in the country. If you get to the airport, you do a declaration. They will give you a certain card. When you get to your home country, the VAT that you were charged will be refunded to you. It is being refunded to you because you did not consume that in their country. Therefore, the VAT that should have been charged is zero. So zero rated principally connotes what? Exports. If you operate in the free zones, those who are in the free zones, they are solely engaged in what? Exports. So that is what the zero rated supply encompasses. Then we go to what? We have also services that we export. As I sit here as Deloitte, maybe there's somebody on this platform who is in Dubai and may require me to perform a certain service for that person. So let's say it's a research. I do the research in Ghana and then I send it to the report to that person in Dubai. One will say that the usage of that report did not occur in Ghana. It did not occur in Ghana because the person is sitting in Dubai. But you see, there's a caveat. If the person has a rep in Ghana, whom I'll provide a report for usage, then the report has been used in Ghana. So you can't say it's what 0 rated. Thank you. Then we have what we call relief supplies. Relief supplies. So for relief supplies, the examples are stated there. Like I did indicate that there are people who are supposed to be charged the VAT. They will be charged the VAT. They will be charged the VAT. Now, when you charge them the VAT, the law relieves them. So they are not entirely recused from the payment of the VAT. They being recused is by an act of law. So I gave you examples like those who are in the UN agencies, when they come in and they bring their goods and everything, their personal belongings, and they are coming to use in Ghana. At the port, they are not charged VAT. You see, they are relieved. But if they decide that I'm leaving this country, so I want to sell my car, then all the VAT in all the taxes they should have paid in terms of indirect taxes will be levied on the car, because you are no more, you finish your term of office as a UN agent, you are leaving the country, but you want to sell your car to someone who will be using the car in Ghana. Therefore, the VAT will be triggered. So that is the different types of what supplies that we have. I did indicate that we have what we call the standard rated supply, the exempt supply, the 0 rated supply, and then the relief supply. Okay. So all that we have discussed falls, and we have what we call types of what? Taxable supplies. We are still on taxable supply. So taxable supply can be categorized into 2 main regimes. All that we have said, it can be categorized into 2 main regimes. We have the flat rate scheme and then the standard rate scheme. The standard rate scheme are people whose turnover, their turnover exceeds 200,000 or more within any 12-month period or within any 3-month period. Now they are supposed to charge the VAT, unless the activity that they are engaged in are deemed as what? Exempt supplies. Now, how do they charge the VAT? And I've already taken you through the model invariably for calculating it. So mathematically, let's say you have a transaction cost of 100. Before you calculate the VAT, if you're on a standard rated supply, you need to add the COVID levy, which is 1%. You need to add the Get Fund and the NHI levy, which is 2.5% each. So if you put all of them together, you are having what? 6% levies. So you add it to what? Or you gross up the transaction value by including the 6%. So if you are taking 100, you have what? 106. And then you charge the VAT of 12.5. So those who are on the standard rate scheme, that is their VAT accounting. So in as much as you charge, you are also what? Charged. So what you are charged, so assuming that I'm into the production of this water, I'll buy raw materials. I'll buy the bottle, everything, to then put it into this. But I'm not the one using it. So the mechanism of the law is such that, okay, fine, because you are not the final consumer, when you sell to the other party and you charge the VAT, recover what you have incurred from what you have collected and give the net to me. That is what we call the VAT accounting. But bear in mind that for the levies, they are straight levies. They are not recoverable. So they become your expense. And that's why people are saying that VAT invariably has increased and not reduced as our politicians would want to make us understand. Then we have what? The flat rate scheme. The flat rate scheme, either two, was for those who are into retailing and wholesaling. Retailing and wholesaling. So the principle was that once you're into retailing and wholesaling, you are supposed to charge a flat rate of 3%. And when you add the COVID levy, it's what? 4%. Now, those who are on that scheme, you are not entitled to what? The input output. Whatever you are charged forms part of your cost. And whatever you collect, you pay to the government. Nevertheless, there were some amendments that were made, this year. So now the threshold has been increased. The rule is that once you are, if you are into wholesaling, you do not form part of the flat rate scheme. You are not part. The flat rate is for only those who are into retailing. And for those who are into retailing, your threshold should be within, that is your turnover, should not be less than 200,000. It should not be less than what? 200,000, but not more than what? 500,000. So the range is between 200,000 and 500,000. Once you fall within this range, you are covered under what? The flat rate scheme. So it is only those who fall, and the decision point is on the turnover. So if you are into retailing and your turnover is 600,000, 700,000, 800,000, you are no more on the flat rate scheme. You are no more on the flat rate. You have moved to the standard rate scheme, and you have to do that as such. So for those who are on the retail, those who are retailers, they are still going to charge the 3% plus the levy, which makes it 4%, and they are not entitled to the input, the deduction of the input. It becomes to the VAT accounting. It becomes their cost, which will go through their normal financial reporting. Now, for wholesalers and retailers whose turnover exceeds the 500,000, bear in mind that I said that your revenue should be within, it should be less or up to 200,000 and not more than 500,000. That one, you are classified as a retailer and you'll be on the flat rate scheme. But if it's beyond, then you have to quickly register for the standard rate. And there are a lot of people who are falling foul of this. When the law catches up with you, you would have messed up with your financial planning and you pay unnecessary taxes to the revenue authority. So principally, those are some of the key terms you would have to know when it comes to what? The flat rate regime in Ghana. Okay. So I have touched on issues on direct and indirect taxes. Betty has also touched on some issues on direct taxes, specifically employment taxes. And like we did indicate, a sound understanding of some of these principles aids in what? Efficient tax planning. So when we say tax planning, it's not anything difficult. Just have to understand. You just have to understand your reporting requirement, your filing requirement, and your payment requirement. So Betty will take us through some aspects of tax planning and tax strategy, and then I'll take up. But in the interim, if you have any question, you can drop that in the chat box, and at the appropriate time, we'll address that. Betty.
Okay. Thank you very much, Gilbert, for that comprehensive overview of the indirect taxes and the business income as well. So we would continue and delve into the actual tax planning and the strategies that can guide you in effectively doing that. Okay. All right, so Gilbert's ran with the quotes, and so let me continue that trend because we are all giving quotes. So a famous investor, Morgan Stanley, has quoted that you must pay taxes, but there's no law that says you've got to leave a tip. So as Peter said, only two things are certain in life: death and taxes. And so you can't run away from taxes, but then you don't necessarily have to overpay what you are statutorily required to. And so as much as possible, tax planning is supposed to effectively help you stay within the limits or the remit of the law and pay as much possible taxes as are required and not to overpay. Okay, so basically we are going to give you guidelines on how to effectively manage your tax affairs and effectively plan your taxes so that you are within that limit. You don't overdo things and then pay excess taxes than you are supposed to. All right, so basically tax planning as defined by Investopedia is the analysis of a financial situation or a plan to ensure that all elements work together to allow you to pay the lowest rates of taxes possible and as legally allowed. Okay, so the aim of tax planning is to legally arrange your affairs so as to minimize your tax liability and keep you also within the law. However, note that there's a thin line between tax planning and then tax evasion. You may be looking at legally avoiding taxes, but then if you overdo this, you might step into tax evasion, which is a criminal law, criminal offense. Okay, so in as much as we are looking to plan our financial transactions such a way that we don't overpay taxes, we have to be very, very, very attentive so that we don't cross over the threshold and step into tax evasion, which as I said is a criminal offense. Okay, so we look at the differences between tax avoidance and then tax evasion. Okay, so tax avoidance, as we have said, is the legitimate means of reducing taxes. Okay, and so with this one, an action is taken to lessen the tax liability and minimize the effects of tax on income. And then this is done by taking advantage of some reliefs, incentives, and allowable deductions, or some others might say some loopholes in the tax laws in order to take advantage of rebates that are being provided. So this is legally avoiding paying excess taxes, all right? And so there's absolutely nothing wrong with this in as much as you stay within the remit of the law. However, tax evasion is the failure to pay or a deliberate underpayment of taxes. And then as I indicated, tax evasion is illegal and then punishable by law. And then if you are looking to reduce your income or overstate your expenses or claim reliefs or deductions that you are not deemed to be allowable to claim, these are all ways of evading taxes in order to reduce your profits or your revenue or your income and in effect pay less taxes. And this, as I indicated, is an illegal offense and then punishable by law. And so, like we said, we need to stay between effectively planning your taxes and then not running into tax evasion. Okay, all right. So what are the strategies for tax planning? Okay, for every transaction that is carried out, these factors will determine the tax implication. Okay, for most individuals or for most persons or for most companies, the mistake that we do is to prepare our return at the end of the year and then look to avoid or reduce taxes. Whereas by the end of the year, all transactions would have already effectively been carried out. The ideal situation is for you to plan even before you carry out the transaction, so that then you are able to identify the tax effect of all the transactions that you are going to carry out and then know how to run your way around it in order to effectively reduce the tax implication of that transaction. Okay, so these variables will determine how these taxes would affect it. The entity that is undertaking the transaction, okay, will determine the effect of tax on that transaction. The period in which this transaction occurs also has an effect on the the taxation of that transaction or the impact of tax on this transaction. The location in which this transaction occurs also has an effect. And then lastly, the activity itself or the transaction that is being carried out itself also determines the tax effect of the transaction. So these are the 4 most important factors or variables that you need to consider before every transaction is carried out in order to effectively plan your way around it. All right. Now, Gilbert would run us through the main anti-avoidance rules. Okay, that's guides or rules most transactions that is carried out, so that then we would have an in-depth analysis or an in-depth understanding of how to legally plan your taxes. All right. So Gilbert, kindly.
Okay, thank you very much, Betty. Thank you very much. I mean, I've always said that one of the key things in tax planning is to understand your reporting requirement, your filing requirement, and your payment requirement. Most of the time when we talk about tax planning, we think too big. The petty things is also important. So tax planning encompasses what tax avoidance and tax evasion. Tax evasion is illegal, but tax avoidance is not illegal. So it premises on what? Understanding the various aspects of the law and the loopholes thereon. Because every law will have some form of what loophole. That is why the lawyers are there. And that is why tax practitioners are also there. So once you plan around it effectively, you would not have evaded tax. Nevertheless, the drafters of the law are also cognizant of the fact that there are some loopholes. So with time, as we put the tax law into practice, the drafters of the law also maybe at the point of drafting the law may not have envisaged some of these loopholes. So as the practice unfolds, these loopholes come on board, and then they come with provisions to also mitigate or address some of these things. So those who listen to global issues a lot, you realize that we have the OECD. OECD is the Organization of Economics. They talk basically about tax issues. So you hear that people are talking about BEPS. What is BEPS? Base erosion and profit shifting. So you erode the base on which the tax will be calculated. The chargeable income, you erode it, but you make it say that you transfer the tax that you pay to other jurisdictions. So our law has come up with what we call the general anti-avoidance rules. So what does it principally talk about? That the Commissioner General has the opportunity. The Commissioner General has the opportunity to do what? To review your contracts, to review your agreements, to see whether the agreement is in line or it reflects commercial or substantial economic form. It meets what? Economic standards. Now, these things normally happen when you are dealing with related parties. When I say related parties, there are companies that have what? Other companies. So they are related because I have company A. I then establish another company. And then through that, I establish another company. So they are all related. So when we are dealing amongst ourselves, because we are related, sometimes the transaction does not reflect economic reality. And there is a tendency to do one or two things. So the Commissioner General, based on these anti-avoidance rules, will assess your contract. That is why in tax planning, contract review are very important. You get a tax expert to review your contract to see whether there are any issues that could trigger material tax exposure for you in future. We also have what we call the arm's length standards. You've heard a lot about transfer pricing. I don't want to, it's a bit technical, but not so technical. All that the law proceeds to say is that fine, whatever transaction you engage in with your related party. So for instance, who can be my related party? I can set up a company and put my wife there as the CEO or the managing director, managing the affairs of the company. And I'll say that, okay, maybe I have a manufacturing company. I set up a cleaning company. That cleaning company is managed by my wife. When they come to clean the manufacturing company on the market, maybe the charge is $100. But because it's a related party, I am charging $2,000. $2,000. But on the market, relatively, all the cleaning companies, if they clean the any manufacturing company, the fee range is between $100 to $500. So why are you charging $2,000? Then that means there is something there. I'm trying to shift profit. See, I incur cost. I put a whole cost in my book, but I'm shifting the profit to my wife's company. In the end, it's coming to the same people. So the arm's length principle seeks to ensure that whatever transaction you engage in at that level is at arm's length, it's within the range when we seek to compare, entities which are in the same activity. So the general anti-avoidance rule, I've already touched on some of them already principally. Good. So the arm's length principle is what I was touching on, and I used a simple example to explain for you to understand. But sometimes when we say transfer pricing, it's big, but it's basically to ensure that whatever you engage in amongst related party, and with the example I gave, my wife's company should have charged, they should have charged either $100 or they can even charge $500. But why are they charging $2,000? There wouldn't be sufficient justification to that. Okay. So basically, those are the anti-avoidance strategy. We have one thing that we call income split. Income split. So let me give you another example. You see, when you buy assets, you are granted capital allowance on the asset. And the capital allowance you are granted is in a way to reduce the tax that you pay to the revenue authority. So the same example, my wife's company, the asset that I'm using is not in my wife's company, it's in my books, but I do cosmetic accounting. So when you go and pick my wife's financial, you see that same asset there. And she is what? Claiming capital allowance on it. So invariably, maybe I may be making substantial profit or making losses. She may also be. So once she claims and I claim, you realize that the tax base has been tempered with. And that is a form of what? Income split. I can have a business. It's not a partnership. It's a business that I'm running. Then all of a sudden, I make my son the managing director. And then I transfer some of the income into his name. Because per my pedigree, my tax rate is high. I pay maybe 30%, but my son pays maybe 5% based on some criteria. So I shift a lot there. So that I'll pay less tax and my son will also pay less tax. In the end, the money is coming to that same family. And the law frowns against that. So this thing has been going on, and this provision has been made to ensure that that is what prevented from happening. Okay. So tax planning, and as Betty Riley said, you realize that she took you to the various variables. In order to also do efficient tax planning, you need to understand the tax issues around the type of business you're engaged in. And that is what we call what? The entity variable. If you are into sole proprietorship, what are the tax issues? If you are into partnership, what are the tax issues? If you have established a company, what are the tax issues? Implicitly, they will not be the same, because sole proprietorship is invariably you, the individual. Partnership in Ghana the partnership is not liable to tax. It's the partners who are liable to tax. So it has similar characteristics as the sole proprietorship. But for a company, it is the company that is subject to tax and not the shareholders. Because for those who are into commercial law or company law, you realize that the tenets have always been that the shareholders are distinct from the company. Therefore, the company can sue their shareholders and the shareholders can also sue the company. So these are the things you need to know in order to aid tax planning. Like I did indicate, if you have any question, you can drop that in the chat box. You can drop that in the chat box. Okay. So we come to what we call tax rates. Let me check. Yeah, Betty, I hope, okay, fine. So I did touch on rates. So these are please go back. So we have the income tax ban for both sole proprietorship and individuals. The income tax ban for both sole proprietorship and individuals. And then partnership, as I've already discussed. I said that for partnership, the partnership is not liable to tax. It's the individual partners. And then for companies, it is the company that is liable to tax. So the shareholders, when they earn dividends, they will pay taxes on the dividend that they have earned. So Betty, you can then take over from here. Okay.
Okay, right, go back. So just let me draw you back a few slides so that I make reference to the applicable rates for the resident individuals for the sole proprietorship. I indicated earlier that we would come to the applicable rate. So as has been indicated here, for resident persons, they are subject to tax on the graduated rate. Okay, so these are the various tax bands, and so determine depending on your level of income, the applicable tax rate is what has been stated in here. So for every level of income, percentage is applied to it, and then when you move to the next level, then you move to the next tax band. However, the maximum you can suffer as a resident individual is 30%, and that is for those with income exceeding 240,000 Ghana cedis per annum, which translates to 20,000 Ghana cedis per month. Okay, so that is it for residents. However, for non-residents, they are subject to tax on all types of income at a flat rate of 25%. Okay, so this is basically how your monthly income is being taxed. So if you want to check your taxes, your gross income as against what you are receiving on a net, then you just run it through this graduated rate, and then you know how much taxes you are paying and if you are getting the right net salary. Okay, all right, so then let's go into tax incentives and then tax reliefs. Okay, so
Betty,
yes, go ahead.
Before you go on, let's quickly address one or two questions and then we can proceed. Or Peter, do we wait and finish before we address some of them?
Yes, please.
Okay, so Betty, please continue.
All right, that is fine. Okay, so tax rates and incentives. So as we indicated, there are some tax reliefs or tax rebates that every sector or every investor can look to take advantage of. Okay, so these are legal ways of reducing taxes by virtue of your location choice or industry choice. Okay, depending on the sector that you choose to operate in, there are some tax holidays or tax rebates that you can enjoy. So this is very important in relation to foreign direct investors. Okay, so these are critical areas or critical decision areas that affect even the sector that these FDIs are looking to operate in. So if there are some sectors that you pay reduced taxes in, and by virtue of location outside of the main capital, then these FDIs would look to cite their location in these other capital towns, so that they would be able to enjoy lesser tax rates. Okay. And so this affects the decisions that they make in relation to where to cite their industries and all that, or even the sector in which you operate. So these are some examples that we have outlined here. And so if you need to make a decision on where to cite your business, if you are looking to set up anything, or which sector to invest in, then these are the factors that you need to consider: the holidays that you would enjoy and the rebates that you would be able to enjoy if you decide to make a decision on any of these sectors. So for the business sector, generally all companies are supposed to be taxed at 25%. Okay. However, if you are in hotel operation, then it reduces to 22%. If you are into trust, it is still 25%. If you are into export of non-traditional goods, then it is 8%. If you are into giving out loans to farming enterprise or leasing by banks, then that also reduces to 20%. If you are registered under the free zone, then after 10 years, you have export sales going for 15%. You have your local sales at 25%. If you are in the mining company, then you are being taxed at 35%. If you are in the petroleum company, you are being taxed at 35%. So this is even the highest tax that is being suffered in the business sector. So as you can see, you would notice that export of non-traditional goods, you enjoy lesser tax rates as compared to the petroleum company. So this is an important investment decision that is made, and you can decide to go into this instead of that in order to take advantage of the reduced tax rates. Okay. In addition to this as well, we have broken down some other sectors or industries that are that have reduced rates, and also some other tax holidays that are applicable if you decide to operate in any of these sectors. Okay, so with the free zones, for the first 10 years, you are exempt from tax. In agriculture, depending on the type of farming that you go into, these are the number of years that you are able to enjoy some rebates. And so if you are looking to go into any of these sectors, these are the benefits that you'll be looking to enjoy. If you are into manufacturing, depending on the location of your company, these are the benefits that you'd be getting. So if you are located in Accra and Tema, which we are all aware are the main business hub of Ghana, then you will be suffering tax at 25%. However, if you are located in any of the other regional capitals, then this rate reduces from 25% to 18.75%. Okay, so let's say Cape Coast, Takoradi, Koforidua, all the other regional capitals, this is the reduced tax that the company would be suffering. However, if you are also located in any other town outside of the regional capitals, then you are going to be taxed at 50% discount. So then the rates applicable will be 12.5. And so as you can see, these are meant to be location incentives, so that as much as possible, the companies or the entities are spread across the country, and they are not located in one hub, as we mostly find ourselves in, where most of the companies are located in Accra and then Tema. There's this incentive for you to look to other locations, even though initially you might be worried about the impact on revenues and other business transactions. Okay. And then also, if you decide to go into real estate, okay, you have a 1% CIT during this holiday period. So you only pay tax at 1%, which is very, very affordable. And so it is meant to be an incentive for more investors to go into this sector. And then also those in the rural banks, for the first 10 years as well, this is a holiday, and then for them, they pay just 1% tax, correct? Same for waste processing. So depending on the business or industry type that you decide to go in and the applicable concessionary rate for some particular number of years, or for even some, it could go on for whenever. Okay, so like I said, they are important investment decision angles that are looked at when FDIs are looking to enter into a country, and then it affects the sector or the industry that they decide to go into. All right. And then also we look at private universities as well, where they are actually exempt from tax. Okay. And then you also have young entrepreneurs, this which is for most of us on this call. If we are able to put up something as a young entrepreneur, then within the first 5 years, you are exempt from paying tax as a whole. And then if we go into these specific industries, then within 5 years, we have these concessionary rates as well that would be applied on tax instead of going for the normal 25% tax rate. So these are also meant to be an incentive for young entrepreneurs like yourself and I to go into business. Okay, all right. So we have already touched base on the applicable rates of income for manufacturing companies that are located in the regional capitals and other towns in Ghana. Yes, and then we also have incentives for employing fresh graduates. Okay, so for companies that have a particular number of fresh graduates. Now, fresh graduates here is being defined as a person who has graduated from a tertiary institution for the first time, irrespective of previous employment. Okay, so if the company hires a particular number of their staff or labor, then they are granted an additional deduction or an additional relief of their salaries and wages, okay, which reduces their profits or their chargeable income before tax is applied on it. So if they employ up to 1% of their staff, making up fresh graduates, then they are granted an additional 10% of their salaries and wages as a relief. If fresh graduates make up above 1%, but not more than 5% of their staff, then they are granted 30% of their wages and salaries. And then if they employ 5% of their staff qualifying as fresh graduates, then they are granted 50% of their wages and salaries as an additional relief. So this is also meant to be an incentive for companies to take up more fresh graduates, because as we are all aware, the job market is very competitive, and sometimes we have most companies requesting for 2 years experience, 3 years, 4 years, and sometimes you wonder how you are supposed to get that as a fresh graduate. And so this is meant to serve as an incentive to encourage the companies to take up more fresh graduates so that they can reduce their chargeable income and affect their taxes. Okay, all right. So another legal way of reducing your taxes is by taking advantage of interest and penalty waivers. Okay, so Ghana currently is running a campaign, for penalty and interest waiver. It is currently ongoing, whereby up to 2020, if you have any liability or taxes that you are supposed to have paid but you hadn't paid, you are granted the opportunity to file these taxes with the GRA and then declare income, file, and then pay the taxes without incurring any penalty or interest for late filing or payment. So this is an opportunity for companies to take advantage of this, because we all know we have filing and payment deadlines. And if you make payment or file late after the statutory deadline, there are penalties or interest that are supposed to accrue on this payment. However, you have been granted this opportunity to file your income and then pay taxes without suffering any interest or penalties on this payment. If you are able to do that under the interest and then the penalty waiver regime. Okay, so this is also a legal way of declaring your taxes in order to reduce your tax liability. Okay, all right. Now, moving on to tax reliefs. Now, this mostly relates to individual or employees. Okay, so with these reliefs, there are ways of reducing your chargeable income. Okay, and reducing your personal income taxes that are payable on a monthly basis or in a year. There are some personal reliefs that are applicable to all individuals depending on the conditions that are to be met. We would look into details in the subsequent slides, which is if you have a dependent spouse, somebody whom you cater for the basic necessities for, this qualifies you for 1,200 currency points. And for 1 currency point, that is 1 Ghana cedi. So essentially 1,200 Ghana cedis per annum if you have a dependent spouse or marriage relief, yes, or you have 2 dependent children. So you can claim this 1,200. It is not money that would be given to you, but then it is money that will be taken out of your income before taxes applied on whatever is left. Okay, so it is a relief. It reduces your chargeable income. And then also, but the only aspect of this is that only 1 spouse can claim it in the case of the dependent children. So you can't have 2 parents claiming for the same children. Only 1 spouse can claim for the children. Okay, and then you also have child education, where if you have 3 children that you are looking after or sponsoring their education, then you would be due to getting 600 Ghana cedis as a deductible relief. Okay, that would be roughly 1,800 Ghana cedis per annum for a maximum of 3 children. And with this as well, with only 1 parent can claim for the same 3 children. So if you have more than 3 children, 1 can claim for this and then the other can claim for the rest, but you can't claim for 2 parents for the same child. And then we also have old age relief, where if you yourself, you are above 60 years, then you can have deductible relief of 1,500 currency points. And then if you also have aged dependents who are over 60 years, for whom you cater for their basic necessities of life, and you are able to prove that, then you also have 1,000 Ghana cedis as a deductible relief. And if you have training and development as well, and you have disability relief, if you, the individual, are disabled in any way, then you are able to prove that, then you would have 25% of your accessible income being granted as a relief. So with these reliefs that have been stated here, they need to be applied for from the Commissioner General. There is a tax relief form that you complete with the necessary supporting documents, and you present to the GRA, and then the Commissioner General would look at the necessary documents and then approve it, and then also grant the amount that should be deductible on a monthly basis, so that then your taxes can be reduced. Yeah, so we are entreating all of you to look at these reliefs that are applicable and know which one that you can claim for, and then just pick up the form, do the needful, and then apply it with the GRA, so that at least you can legally reduce your taxes as much as possible. Okay, and then we also have mortgage reliefs. This is relief for mortgaging a house, and it is available to only resident individuals and on 1 property in your lifetime. So if you go for a mortgage, then the interest payment on this mortgaged property would be granted as a relief to you. And so what the GRA does is that the interest portion that you are paying is deducted from your income, and your taxes are reduced thereof. So with this one, you don't also need any approval. You only get the mortgage schedule from the authority or the company, mostly it comes from the Ghana Home Loans or which other company that is providing that mortgage to you, and then you present that to your employer, and then we grant that as a deduction for you. So with this, you don't need any approval from the Commissioner General. And then if you are also able to make donations to a worthwhile cause, now these worthwhile causes are, some examples have been provided here. The COVID relief fund, if we are being current, is one worthwhile cause that if you donate to, that amount will be granted as a relief to you. If you donate to a charitable organization or a scholarship scheme or a development of rural urban area. And then I remember the June 3rd event or the June 3rd incident as well. The donation that went into that fund was also deemed to be a worthwhile cause and so deductible for tax purposes. Yeah, correct. So these are the reliefs that are available. And then legally, that you wouldn't have any issues with the tax law. It doesn't count as tax evasion. These are allowable deductions or reliefs that reduces your chargeable income and in effect reduces your tax payable. All right. Now, as I indicated, this is an example of the tax relief application form. So as you can see, you complete it with the details that are being requested for you, attach the necessary supporting document, and then you submit it to the tax office. And then they would look at the documents and then assess if you meet the criteria of the relief that you are applying for. And then they would grant you a relief card indicating what should be done, the amount that should be granted as a relief on a monthly basis. Okay, sometimes this is renewed on an annual basis, or it could also be given for more than 1 year, depending on what the Commissioner General may decide. Okay. All right. Yeah, right. So tax planning. Okay, we have looked at legal ways or legal means, rebates, reliefs, concessions, or other loopholes that can be run through in order to legally reduce your taxes. However, the most effective of all is to actually comply. Okay, if you comply, then you wouldn't have any issues with the tax law. All right, and I'm sure each and every one of us would agree with this one. Now, what are our obligations, okay, with respect to filings and then payments? So these are essentially what you are required to do. You have registration with the tax authority, you have to maintain proper documents, you have to file tax returns as and when they are due, and you have to pay taxes regularly as and when they are also due. Okay, and in Ghana, we find out that most of the filing obligations lies with the employer. And mostly this is because of the fact that it is easier to locate employers or track employers instead of tracking the individuals. Because if you say we should all withhold our taxes or calculate tax on our income that we are receiving and then go and pay to the GRA, that would be very, very difficult to administer, because then we would have to be chasing individuals. We don't necessarily have the database for that. And so what we do is to place the filing obligation on the employers, and they are required to withhold and then make the payments to the GRA. So these are the employer obligations. Every employer must pay to the GRA within 15 days after the end of each month PAYE withheld during the month. So this is the taxes on employment income. Employers are supposed to withhold these taxes on a monthly basis, pay the individuals then their net figures, and then remit to the GRA within 15 days after the end of the month. And so taxes due for, let's say, March 2022 would be due on 15th April 2022, which is 15 days after the month ends. If there's a holiday, then it moves backwards, or it's a weekend, the 15th falls on a weekend, then it moves backwards. And then also, employer must file with the GRA within 15 days after the end of each month, the statement in the manner and form prescribed by the commissioner. Now we have payments and then we have filing obligations. Filing obligations is filing the deduction schedule or the return with the income, what has been deducted or what has been withheld. And then payment is actually paying what has been withheld with the GRA. And we have separate penalties for these two obligations. You have penalties for late filing and you have interest for late payment. And so as much as possible, even if you can't complete one of these obligations, you need to complete the other. Most of the times companies are, or they find themselves cash strapped. And so they are unable to make payments of taxes that have been withheld. But what they can do is to at least file their returns so that penalty on the late filing is eliminated, and then they can only look at, let's say, interest on the liability outstanding. So two obligations, filing and then payments, which are not linked per se. There are two separate filing, two separate obligations that must be looked at. So as much as possible, you need to complete both of them. And then any employer who fails to withhold the required PAYE must pay the tax that should have been withheld in the same manner and at the same time as tax that is withheld. So employer obligations, the obligations lie squarely on employer. If the employer fails to withhold, then the GRA would chase the employer for that. If the employee receives their salary without the tax being withheld, then that would be would solely rest on the employer to pay the taxes. Okay. Now we have annual filing obligations in addition to the monthly filing obligations. You have the employer's annual deduction schedule, which is a schedule that shows a list of all the employees of the company, taxes that have been withheld and paid on behalf of these employees. And this is supposed to be filed on 30th April of the subsequent year. Okay, so employers' annual deduction for 2021 needs to be filed by April 30th, 2022. Now this year, 30th April falls on Saturday, and so it moves back to 29th April. So you are supposed to file employers annual, all employers are supposed to file employers annual deduction schedule for 2021 by 29th April of this year. Okay. All right. In the same vein, we also have personal income tax return filing, which is also an annual filing obligation. And this is mostly the only obligation that has been solely put on the employee. So with this particular filing, the obligation lies with the employee, and they are supposed to file their personal income tax return showing their income from business, investment, employment for the whole year, for the year of assessment, for January to December. And this is also due to be filed by 30th April of the subsequent year. And so return for 2021, personal income tax return for 2021 is also due on 29th April 2022. Okay, and every individual needs to file this return. So if you are here and you haven't done that, kindly do the needful. Just go to the GRA website, download the personal income tax return, complete it. It's not really that difficult to do. If you have your figures or your pay slips or your monthly compensation, you can just put that together and then file with the GRA, because there are some documents that you need from the GRA that would require you to file your personal income tax return. And so you are all entreated to do the needful and then file with the GRA as required. Okay, so for every individual that receives a chargeable income within the year, they are all required to file tax return for the year of assessment. All right. Now, in the previous slides, looking at the tax reliefs, I just want to touch base on one other tax planning tool that we can look at, and that is in relation to Provident Fund or SNIT, Social Security contribution or pension contribution. Now, the pension contributions are granted as reliefs. Okay. Now, for pension contribution, we have the three tiers: tier 1, tier 2, and then the tier 3. Tier 1 is mandatory as well as tier 2. However, the tier 3 is a voluntary contribution, which is also termed as the Provident Fund or the PF. All right, so tier 1 goes to SNET, the Social Security and National Insurance Trust. Tier 2 goes to an approved fund manager. Now, approved is a fund manager that has been approved by the NPRA. There's actually a list of entities that are approved by the NPRA that if you register with them, then it would be granted as a relief. If your entity is not registered with the NPRA, then it wouldn't be granted as a relief. And then the same range for the tier 3 as well. We have fund managers that if you register with them, then it would be deemed as an approved or yes, as an approved relief. So what happens is that for pension contributions, we all know that it is made up of 5.5% contribution from the employee and then 13% contribution from the employer. So these are the mandatory contributions, which makes up 18.5% the total mandatory contribution. However, we also have the third tier, like I mentioned, which is voluntary and not mandatory. However, if you contribute to the third tier, it can be granted as a relief, as I said, if it is to an approved fund. And if it is within 16.5% of your basic salary, then it would be granted as a relief. If you exceed this percentage, then that wouldn't be granted as a relief. So it is such that you enjoy the additional 16.5, but then you can't also push all your income to PF and say, okay, I'm contributing 50% of my salary to PF. I mean, that would just, we would all contribute everything to PF and then we wouldn't have any taxes left to pay. So there's that threshold that has been put on there to ensure that it is reasonable. Okay, so if you contribute between 16.5 of your salary, then that would be granted as a relief. So this is an additional contribution that can be taken advantage of to reduce your taxes when it comes to individual employees. And then also there is another tax planning tool, okay, where individuals can take advantage of. So let's say if you are in employment negotiation or contract negotiation with your employer, and then you are being granted allowance, housing allowance, or fuel allowance, or let's say transportation allowance. These allowances, if they are paid out as cash, okay, they will just be added to your income and then taxed using the graduated rates. However, if these facilities are given to you, then there are values that are assigned by the tax law, which is lower than probably what you would have gotten as a monthly allowance figure. So let's say if you are being given housing allowance of 1,000 Ghana cedis per month, okay, which you would say that's fine, it's okay, 1,000 cedis is fine. If you are being taxed, this housing allowance is a taxable income. So we are saying that we would add this 1,000 cedis to your income and then run it through your graduated rate, which if you are in the 30% bracket already, that would be 30% of 1,000. That would be 300 cedis that you would be incurring as a tax on a monthly basis. However, if the company gives you the house or the accommodation for you to stay in, then the DRA has assigned a value to this benefit that you are given. And that would depend on whether it is a furnished accommodation or just the accommodation, or if it is shared or it is just furnishing alone. So let's take, for example, if it is a furnished accommodation, which is the maximum, then it is supposed to go at 10% of your TC, your total cash emolument. So if your total cash emolument is, let's say, 5,000 cedis, 10% of that would give you 500 cedis. So this is the value that would be allocated to this accommodation benefits that you'd be getting. Now, if you compare this to the housing allowance that you are getting of 1,000 cedis, the allowance is more than the benefits. And so the tax effect would be different, or it would be lesser. So what happens is that instead of taking or accepting this housing allowance, you can have a discussion with your employer for them to provide you with the accommodation, which will then come at a lesser value or lesser benefit compared to the allowance figure that you would have gotten. Okay, so these are all negotiation taxes, and then this might come at an increased cost to the company as a negative or as a disadvantage, but then you are looking to reduce your tax liability, and so for you, you would have reduced your tax payable. Okay, in the same vein for fuel or transportation, or if a vehicle is provided to you, that is also valued differently as against when you are giving the allowance of, let's say, fuel allowance of 1,000. Okay, so these are all aspects of negotiations that we can look at in order to reduce our chargeable incomes and effect reduce our taxes. So this is just what I wanted us to have a look at when it comes to our employee taxes, and then the tax planning strategies that we can look at. All right.
Okay, thank you very much, Betty. Betty has delved deep into tax planning issues, and of course, as we did indicate, we are here to give you nothing but the best. So we'll wrap up with some of the compliance issues you must know. I did indicate at the inception of our discussion that 3 things are cardinal: your filing requirements, your reporting requirement, and your payment requirement. And all of them have sanctions. So if you want to effectively do your tax planning, in addition to what Betty has alluded to, you have to pay particular attention to this. And Betty hit on one important point. She said that, okay, you may not have money, but you go and file so that you comply with your filing requirement, so that you deal with the payment requirement later if you have money. Maybe if you are lucky, there could be some waivers if you are lucky. So what are the filing requirements? Withholding tax, you have within 15 days of the subsequent month to file. 15 days. The law is saying up to, within 15 days. So you don't have to wait till the 15th day. Anytime within the subsequent month, you can go and file. PAYE is the same. VAT, you have up to the end of the subsequent month, not later than the end of the subsequent month, to file your VAT return. So you would have engaged in the transaction, you would have issued your VAT invoice, you have to then comply. And it's not premised on whether you have received payment or not. And that is where people get it twisted. Whether you have received payment or not, the law is saying that you have to file and pay the taxes. Of course, you may get some cash flow issues, but that is what the law wants us to do. The same requirement holds for the GET fund and the NHI, or the COVID and the COVID levy. You have to file them within the same time frame as the VAT. Now, when we come to corporate income taxes, we have what we call self-assessment. The law requires that you, at the beginning of the year, based on your own estimates, tell us how much taxes you can pay. Every prudent company does budgeting at the beginning of the year. So when you've done the budgeting, you do projection of your expense, projection of your capex budget, I mean, assets that you buy, your revenue, based on that, because government cannot wait for you to determine your income at the end of the year before they engage in social interventions. So they are giving you the room that file, self-assess yourself, and it's done at the end of the first quarter. You give them your returns. It's okay, for this year, I can pay 1 cedi every quarter. So for every quarter, you make sure you pay your 1 cedi. Nevertheless, if for one reason or the other, you think that what you have projected for, you are not seeing the reality, you have the opportunity to revise. And that is one aspect of the planning. If you don't know the revenue guys, what you have put there, they will ask you to pay. So you have to have an effective management accounting system in place to be monitoring. But when things are not going well, you do the needful. Then at the end of the year, when you have all your activities in place at the end of the year, the actual performance, the law is cognizant of the fact that you have to do your audit, close your book. So you are given 4 months, not later than 4 months after your financial reporting year. Your financial reporting year could be from January to December, or it could straddle between 2 years. When I say straddle between 2 years, maybe your financial year starts 1st February. So if I'm looking at year 1, we are looking at how many months? 11 months, and the other month goes into the subsequent year. So that forms your financial year. So that is the time frame you have 4 months after that to do your filing of returns. If for one reason or the other you cannot do that, you have to then apply for an extension. But the extension will not recuse you of your payment requirement, because reasonably you will know what you have to pay once you have the actual figures in place. Finally, you also have to file your annual returns, filing of annual company accounts. You file it with the accounts. You file same with the GRA. So you file them together. When you look at what Betty took you through, you realize that there's a requirement to maintain your documents. And one of the documents is the financial report, your financial. So you file same with the GRA or the Revenue Authority. Okay. Let's move to the next slide. So for withholding taxes, I have the payment requirement. So this tries to look at what? The payment requirement. We have looked at the time of filing. We are looking at the time of paying. So reasonably, it stands to reason that the time of filing goes in tandem with the time of payment. So once you file, you make the payment. But if for one reason or the other, you cannot pay, then you don't have to, break the 2 rules. There are 2 rules involved here: late filing of return and late payment of the taxes. So for tax planning purposes, you manage one of them if you have cash flow issues, and you would have made some substantial savings. So that is what this slide principally covers. Okay, let's move to the next slide. So I said we have what? Filing requirement, payment requirement. If you don't file on time, you pay penalty. If you don't pay on time, you pay interest. That is the opportunity cost for holding on to money that is due to government. So when you go to the Revenue Authority and say, hey, you did not pay on time, so come and pay penalties, you clearly know that the person does not understand the law. But if you do not report rights, there are instances where you can find yourself in prison. You can find yourself paying penalty fines. So offenses, failing to comply with the tax law. There are provisions in the law, and that's why we've taken you through the issues stated out in the law. We've taken you through that. There is a reason to aid tax planning. You have to understand the law, because if you fail to comply with the law, you will be fined. And you not only be fined, you may find yourself in what? You may find yourself in prison. And if you look at our slide, it said what? Liable to a summary conviction of a fine of not less than 1,000 penalty, or not more than 2,000, or a term of imprisonment. And that is where I love most, a term of imprisonment. And I don't want any of my participants to be ex-convicts. So please, you need to pay particular attention to this. And then making false statement to the GRE. That is a reporting requirement. If you make false statement to the GRE, and they get to know, my brothers and sisters, as was said one time by my Ghana's ex-president, my brothers and sisters of blessed memory, my brothers and sisters, I don't want you to be an ex-convict. So please make sure you comply with the tenets of the law when it comes to tax planning. Betty, let's go to the next slide. I like the way Peter is smiling. I don't want anybody to be an ex-convict. So Deloitte is done with our submission, and we've dealt extensively with some of the issues. I mean, this cannot be a 2-hour thing, but we're trying our best to ensure that we touch on every issue within the 2 hours. It's time for questions so that we address some of the issues and then we take it out from there. So thank you very much for the opportunity. And my bosses are very pleased, as I indicated. Gloria, we stepped in for Gloria, our boss. We have other boss, George Kuma, he's the tax lead. And then we have our other Gideon, Ayi Otu, who is also our tax partner. So we are representing their interest, and we do hope that we've done justice to the subject matter. But of course, you are the judge. So thank you very much for that opportunity.
Great, great, great. This has been an insightful, eye-opening presentation. Listening to you, I've got a lot of insight into the Ghana tax law. So we thank you very much for this insightful presentation. Questions? We have a lot of questions in the chat box, so I will read them and you respond to them. So the first question is coming from RK. Thanks for the amazing presentation. Please, what tax planning or strategies are available for the sole trader as the informal sector forms a significant part of the economy? In effect, what basic knowledge or processes should a sole trader go through to remain tax compliant? That's our first question.
Okay, so let me quickly address it. So I'll tell my brother that for a sole proprietor, your key first requirement is proper record keeping. And that is what most of the sole proprietors are missing, proper record keeping. That is one. Two, proper distinction of your business activities from your personal activities. Oh, I took some of these to go and pay my son's school fees. Hey, I took some of these to buy this. Hey. So there should be a distinction between your business records and your personal records. Have a very good auditor and a very good accountant, financial system in place to record all these things before I even think of the tax. Because you see, the tax starts where the accounting ends. So if you do not do it right, you have issues with the taxes. So now we go to the tax planning opportunities available to you. One, as a sole proprietor, you realize that the sole proprietor is as good as the individual. Betty made mention of some personal reliefs, SNITs, pensions, all these things mentions when she made mention of those things. She made mention of what? Graduate reliefs. All these things are the benefit that you, the sole proprietor, you can take advantage of. You can also take advantage of some location incentive if you are into manufacturing. So at a higher level, this is what I would ask you, the sole proprietor, to pay attention to. But the over-anchoring thing is proper records keeping.
Awesome. Proper record keeping is essential to know if you want to plan your taxes. Valentino is asking, I think in the course of your presentation, you answered this, but I'll go over it. And maybe if you have any other thoughts. Do businesses have to file a separate tax return? Do they pay a business tax income, or are profits allocated to owners and reported on their personal returns?
Okay, so thank you very much, Valentino. So we need to then situate this in the various classes or types of business. So I'll start with a company. A company is distinct from its shareholders. So the company is supposed to file its corporate or company income tax return on its activities. The company is also a withholding agent. If the company engages in a taxable activity, the company is supposed to charge VAT and be charged VAT. And this is devoid of the shareholder, because in company law, they are distinct. Now, because the shareholder has interest in the company, at the end of the year, if the company is profitable, the company management, the board of directors will take a decision that we should pay dividend to shareholders. This is what we call what? Investment, income from investment. So the dividend you pay to shareholders, the shareholder will also suffer tax, withholding tax on that dividend of 8% on that. So if we put it within the context of a corporate institution, this is it. Now, when it comes to partnership, I did indicate that for partnership in Ghana, the partnership in essence has no legal status in essence. It is, when it comes to income taxation, it is the individual partners. So at the end of the year, the partnership, which is more like an entity, will have some requirements. The partners will have withholding requirements to do, because you're also engaged in business. But when you do all these things and you get to your profit, that is when you have taken all your taxes, the profit that you earn. And in this context, you don't talk about tax. The residual, the profit, having taken into account all your expenses by the partnership, the profit is shared among the partners. And it is at that point that the individual partners are liable to pay taxes. So for them, because they are seen as individuals, they are taxed based on the graduated rate, which Betty took us through. And that same principle holds for what? Sole proprietorship. Okay.
Great.
And the question on the dividends that the company pays, are they deductible from the company?
Very good question. The dividend, if we go into financial reporting, the dividend is not an expense of the company. Dividend is paid out of what? Profit after tax. It is paid out of your retained earnings. It is paid out of what? Your income surplus. So that cannot be deductible to the company, because in reality, it's not an expense.
Thank you.
Great. So we have another question here. In addition to tax planning, for personal liability issues, is it an advantage to the business owner to form a corporation versus doing business as a sole proprietorship or partnership?
Okay, so that is subjective. That is subjective. It depends on the mode of activity that you are into. Now, a lot of companies that you see today started on a tabletop. If they are to give you, I mean, talking about indigenous Ghanaian businesses, not businesses that expatriates have come to set up, they started for. So as the business grows, you will realize that I can no more operate as a sole proprietor. I need additional investors to come and support the business grow. And no investor will come and support unless you're a family member. So then the status of your operation must change into what? A company where you have shareholders and you have other board members, well formalized. So as your activity grows, that will determine the kind of operation you find yourself in.
Great. This person is also asking, if I am a sole proprietor who hitherto has been in business for say 3 years without paying taxes, and I want to regularize my exposure to tax and be tax compliant, what do I do?
Okay, So you see, it's just unfortunate we are having this discussion at this time. Tax planning also encompasses you taking advantage of what we call the tax amnesty. Government is saying that I know that there are people who have done things, but they should come and declare. I'll wipe off their sins. That is the penalty and interest. Pay the principal and go your way. So for you, the first thing is, I hope you have a proper accounting system in place. That is one. That has captured in detail all the activities that, and not fictitious, a lot of sole proprietorship. You see, I always tell people that you try to reasonably pay for quality. Because if you don't take care, the wayside person, oh, no, let's do this thing, and when one day to bite you, and it will bite you hard. So get a good accountant who will reasonably help you to structure your accounts. When you are done, then the tax consultant comes in to do what we call a tax health check. A tax health check is like a tax audit, but with this, what we'll do is for management, it's for you, it's for your consumption, it's not for the GRE. So we do a thorough tax health check and we say that when we did the check, these are where the problem is. This is what your liability is. This is what the interest is. So in the process of regularizing your operations, this is what we have to do. We tell GRE, okay, fine. You know, I used to now, it was informal. Now I want to formalize things. I've done it. This is what I've seen. So how do we deal with it? If you can take advantage of the amnesty, but unfortunately, the amnesty will expire by June. So it depends on the quantum of the liability. So if we had this discussion earlier on, we can even push for a payment plan to manage this, and then you regularize your activity. But all is not lost. At least I think that it's very important that you regularize it, and then you try to, address some of these issues that may come up. So that is what you must do.
Fantastic. The next question is, if you make a contribution to Peter's NGO, CFLE Africa, would that reduce our income taxes? If a business makes the same contribution, is it considered a deductible expense?
Okay,
so that's the question.
So we did, like Betty did mention, that donation for a worldwide cause. You understand me? And then the worldwide cause has also been defined in the law. So for instance, if Deloitte is making donation to Peter's NGO, Peter's NGO may not necessarily be written in the law, but is it a recognized NGO? Now, what are the conditions for saying that Peter's NGO is a recognized NGO? Do they have the requisite approval? If it's an NGO, maybe the social welfare and all those people, you have all those things to give credence to the fact that indeed you are an NGO. So some of these things may not have been written black and white in law, but when all these conditions or these documents are available, what is the object of the NGO? Oh, their object is to provide financial awareness to the less privileged. There's evidence to show all these things. Then it can be construed as a donation towards a worldwide cause, hence I should be granted deduction for that donation, or it should be allowed as an expense. The problem is people don't pay attention to this documentation. Oh, we gave donation to this. Oh, we gave donation to this party. Now, what if you give a donation to a political party? It will not be allowed. What is the modus operandi of the political party? But if you give a donation to Osu Children's Home, it is commonly known. There are other homes that may not be known, but their documentation from the various ministries and agencies supports the object of what they are into. And based on that, you can take deduction for that.
Great, great. Our last but one question. What do you and Deloitte work with? Do you and Deloitte work with individuals and businesses on their tax filing requirements?
Yes, we do.
And tax planning needs.
Yes,
business and financial planning needs as well.
Exactly. Deloitte, we do this a lot for companies. Normally, people will think that, oh, Deloitte, Deloitte, for the charge, it's not about the charge. I mean, we sit to have discussions, and we always want to grow with businesses. Betty's team, they help a lot of individuals to file their return. There's individual returns, which is very, very important. Myself, I'm talking about it. I have not done it. I have to do it, or else one day, if I need something and they say, bring your tax clearance, I'll be found wanting. So we have a team in-house that helps in what? Tax planning, and we will review your contracts and then let you know how or the reasonable steps to take. We also have a team that do financial advisory. Like I said, the tax ends where the tax starts where the accounting ends. And what encompasses accounting is financial reporting. So they work hand in hand. So we are always available to assist. You can always walk to our doors and then knock, and then we'll open it up for you, for us to have that discussion. And we always agree to disagree. And then we can then take it up from there. So cost should not be a reason for not coming to Deloitte. That is all I'll have to say.
Okay, great. Before I ask my personal question, I have one question here. Do you have to pay tax on inheritance?
Great. You see, I like the way you put it. We don't caption it as what? Inheritance per se. You understand? Because in the UK, we have what we call the inheritance tax, if you look at the UK law. But then what has been bequeathed to you can be construed as a gift. In essence. So we do not have provisions on inheritance tax, but we have provisions that seeks to address some of these things in our law, but not captioned as what? Inheritance tax. So whenever someone dies and bequeaths his estate to you, that estate could be valued and be deemed as, when it is valued and it is transferred to you, it is deemed as you haven't earned something. But then the cost to you is as good as the value. So the net base principally could be zero. So that is how the model works. But it is in our laws, but not captioned as what? Inheritance tax.
Great. My last question, this goes to you and Betty. This month's campaign, the theme for this month's campaign is financial literacy, a tool for wealth creation and economic development. On your perspective, how do you think financial literacy can help develop the economy of Ghana?
Good. So Betty, I want you to talk more and then I'll take it out from there, because other than that, I'll be talking and then people will not be happy with me and say, oh, this man is
yes. I mean, yes, financial literacy is very important. What you are unaware of, I mean, you cannot plan against. So it is very essential that we are all made aware of what or how to manage our finances effectively. I mean, you can never start too early or too young, even with regards to planning your pension. The earlier you start, the better. You don't have to wait till you are 40, life begins at 40 before you then start planning your pension. Immediately work starts or you start to implement, you need to start putting plans in place to ensure that your retirement looks solid. Okay, so financial literacy is very important, and I must say I am impressed by the work that your team is making in organizing these webinars for young people. And so it's very essential. I'll just entreat all of us to take these webinars serious, because for now they are coming at free cost or at no expense at all. It's just free transfer of knowledge. And so we should all take advantage of that, and to ensure that we grab the maximum knowledge that we can from each of these sessions, and then to effectively start planning our lives, our finances, and then our pensions, so that by the time we are reaching or retiring, we are not found wanting. Yeah, so basically that is what I would want to say with respect to that. So kudos to the work that you guys are doing. Yes, Peter, you are doing marvelously well.
Yes. So Peter, it's a fantastic job. I will answer your question with a practical experience. You know, when I started work, I decided that I'll pick, let's say, an investment package for, then I wasn't even married, just for my kids. So I went to one of the investment house. I started with 50 Ghana cedi or so, or 20 Ghana cedi. Over time, by the grace of God, I had kids, and then COVID set in. So they were supposed to study from the house, and they needed to have a laptop. So I have my laptop, office laptop. Am I to give it to them to have online studies or what? Then I went to that investment that I had done some years ago, took some and bought a brand new laptop for them to use for the online studies. That epitomizes financial awareness, because then I would not have been able to raise that amount from my current finances to buy a brand new laptop if I had not taken that decision some years ago that I started with. So financial awareness is key. This helps the economy, because the investment that you make, government also borrow. It's a cycle. And you see, it's comfortable if you have your money with government, other than these 2x4 investment houses promising skyrocketing investment interest rates, which are not realistic. So it's very important, and we are happy to be partner with your team to create that awareness for people to understand. And of course, tax is not devoid of this, because I always say that if you plan well, you can make a savings of 1 Ghana cedi, which you can invest, and that 1 Ghana cedi can bring you a lot of returns in future. So thank you very much.
Great. Thank you very much. On this note, I will invite Valentino to make some few comments and give us the vote of thanks.
No.
Hello, Valentino.
Hello,
Valentino
Peter. Thank you.
Is our strategic partner in the US. He's the executive director for the Financial Awareness Foundation.
Let's complete the slides. We've got a couple of more slides to go back to. Do we have the slide presentation on screen now?
No.
No. So hold on here. Let's see here. Is it appeared now?
Yes.
Okay, excellent. So we've just completed the tax planning.
Yes, I said I was going to give out some gifts. So let me give out the gifts. Okay, so as part of the Financial Literacy Month, we are giving out free publications and articles, material, books that can help you better manage your personal finance. So when you go on our website, CFLEAfrica.org, you get access to a 12-month financial fitness calendar. This will take you through what you need to do every month of the year. So in January, we are saying organize your paperwork. In February, update and review your net worth statement. In March, review your investment plans. In June, review your employment benefits to discover your hidden paychecks. In August, talk with parents about their estates and financial plans. In November, set financial goals for the coming year. And of course, in December, you need to schedule an annual family financial meeting. So when you get access to this calendar, it will take you through steps that you need to implement each month of the year. We also have the TFAF personal finance publication set. So the first one is an overview on the essential principles to smart money management. We also have your financial partner guidebook. This talk about the essential principles from paperwork to taxes, to investment, to estate and gift planning. And we have a comprehensive book on estate and gift planning. So all these 3 books are available on our website, CFLEAfrica.org. You can also get it on the Financial Awareness Foundation website, the financialawarenessfoundation.org. They are free. Download them, read them, and practice them to set yourself up for financial success. So yes, Valentino, I think you can now give out your comments and do the vote of thanks for us.
Yeah,
Thank
Peter, my namesake Gilbert Boache asked the question. He said, is there any mechanism in Ghana that checks who gets an inheritance tax and how much can be? Unfortunately, you know, our tax system is evolving. It's not like other jurisdictions where things are readily known. So currently, there are no strict mechanism, but it's embedded in our law. So when it is identified, you know, when you are caught foul of the law, that is when you know that something exists. So within our system, it makes it seem as if some of these things can go unknown, but with time, it could be identified. So that's the answer I have to your question.
Okay, sure. Thank you. Before Valentino comes in, we have Joseph with us. Joseph is with Deloitte, and Joseph will do a quick solidarity message on behalf of Deloitte. So Joseph, if you are here, the floor is yours.
Okay. Good evening, everyone. Good evening to everyone on this call. I am Joseph Mensah, and I lead the client and industries team in Deloitte, Ghana. Basically, Deloitte is very happy to partner with your team to ensure that we spread the word for financial literacy. At Deloitte, we are led by the purpose of making an impact that matters. And we are making impact in 3 folds: to our clients, to our people, and the most important one is to our society. So we see this as a partnership that, you know, is going to benefit the society in general. And we believe in the power of financial literacy. So at Deloitte, we just want to assure you that through every step of the way, if you need our help, just call on us, and we are happy to work with you to make an impact in society. Thank you.
Great, thank you very much. And we are glad, we are excited doing this with Deloitte Ghana. Valentino.
Joseph, Gilbert, Betty, thank you for a great presentation and in sharing the importance of tax planning as an element of comprehensive financial planning. Also, happy Financial Literacy Month to all Ghanaians from the United States and from the whole world. We right now have a financial illiteracy epidemic that's true in all countries. We really haven't done a very good job of teaching personal finance in home and school. And it's not an intuitive life skill. As Gilbert mentioned, we have changing tax laws. We have a changing economy. We have a war that popped up almost out of nowhere. We have COVID that approached us almost out of nowhere. So without some advanced thinking, without problem solving, without looking forward and trying to make things better, life becomes a very big challenge. If we can implement some of the tools that were discussed today and some of the materials that Peter's sharing, it can make a world of difference. We believe having better personal knowledge changes your world and the world around you. Once again, thank you for all your great work and look forward to a bright future. Happy Financial Literacy Month, everyone.
Thank you. Thank you. Thank you very much.
Thank you, Valentino. Thank you, everyone. We end our section today. We say a big thank you to Deloitte for being our presenters today. That was an insightful and educative presentation. And we hope everyone will apply the lessons, the insights to help them better plan their personal finance. Thank you and have a good evening.
Thank you too. Bye-bye.
Thank you too. Bye.
Bye-bye.
Bye-bye.